Welcome back, everyone. So, if you've been glancing at the headlines lately, you've probably noticed that the defense sector seems, well, absolutely unstoppable right now. But as we're going to uncover in today's explainer, there is a massive, fascinating gap between those flashy headlines and the true financial reality happening behind the scenes. We're going to look at the defense industry like a giant iceberg, because what you see right there on the surface, that's really only a tiny fraction of the story. Let's start with a hook. Global defense spending has recently crossed $2.8 trillion. That is an astronomical amount of money. It's being fueled by rising geopolitical tensions, massive multi-year commitments from NATO, and, rapidly accelerating defense budgets across the Indo-Pacific. But this brings us to the core iceberg question of our explainer today. Does a $2.8 trillion boom actually guarantee profit for the companies involved? It's so easy to just assume that mere exposure to this huge tidal wave of demand equals guaranteed free-flowing cash. But spoiler alert, it absolutely doesn't. We're going to unpack exactly why this bait and switch happens. Let's get right into Section 1, the boom, record budgets and backlogs. To really grasp the sheer scale of this current multi-year defense supercycle, we first need to define our playing field. When we talk about the defense industrial base, or the DIB, we're talking about a vast, incredibly complex network of public and private organizations, facilities, and resources that provide a government with the materials and services it needs for defense. It's not just the government acting alone. It's a massive, interconnected web of private contractors, manufacturers, and tech companies. Okay, let's dive into the data here, because the numbers are truly eye-opening. Look at the third quarter of 2025. Lockheed Martin pulled in $18.6 billion in revenue, but they have a staggering $179 billion backlog. RTX, they hit $22.5 billion in revenue with a $251 billion backlog. And Northrop Grumman recorded $10.4 billion with over $91 billion in the pipeline. I mean, to put that in perspective, these companies have years, sometimes a full decade of guaranteed work just lined up and waiting. And that financial hype, it's driven by intense physical realities. Advanced aerospace programs, next-generation jet fighters, complex missile defense systems, they all require unprecedented programmatic demand. We aren't just talking about quick reactionary spending here. We're looking at forward-committed 10 to 20-year contracts from NATO and allied nations. The demand is structurally locked in. Which brings us to Section 2, the drone revolution, 21st century warfare. Now, shifting our focus over to unmanned aerial vehicles, what's really fascinating is the extreme economic disparity in how these systems are actually deployed today. On one hand, you've got the Iranian Shahed 136 loitering munition. This is essentially a kamikaze drone that uses commercial, off-the-shelf parts and costs roughly $35,000. On the complete other extreme, you have an advanced U.S. drone like the MQ-9 Reaper, which comes in at a whopping $64 million. It perfectly contrasts the wild technological and economic differences playing out on modern battlefields right now. And because of how wildly effective these systems are, the market is just exploding. The global AI and drone market is projected to reach an incredible $47.1 billion by 2033. This growth is being heavily fueled by massive legislative acts, like the U.S. Department of Defense's recent $33 billion funding injection, which is specifically targeted at drones and AI capabilities. So why this sudden massive surge in AI? Well, it's a structural strategy shift. AI allows for autonomous navigation, even through really dense electronic interference. It enables target locking via onboard cameras if communication gets jammed or lost. It can control multi-drone swarms from a single interface, and it powers the advanced counter-drone systems we need to defend against these exact same threats. It mitigates human risk while drastically changing the operational realities on the ground. Time to dive deeper. Section 3, the execution trap, under the iceberg. Pivoting sharply below the surface now, risk actually manifests very differently depending on which side of the industry you're standing on. In the defense sector, the risk is programmatic. It involves these 10 to 20-year fixed-price contracts. If it suddenly costs more to build a system than originally planned, the contractor often just has to eat that cost. Commercial aerospace, on the other hand, faces operational execution risk. They mainly struggle with scaling up volume and pushing past incredibly tight supply chain limits. What's truly interesting here is how much labor impacts the bottom line. Building these advanced systems obviously requires highly skilled workers, and direct labor can actually account for up to 35% of total manufacturing costs. With the current workforce shortages and wage inflation we're seeing, labor constraints act as these massive structural bottlenecks that severely eat into a company's profitability, especially during the early stages when they're just ramping up production. So the absolutely crucial point is summarized perfectly by Crispedia Research. Realized outcomes will depend on execution rather than exposure. Think about that. A massive decade-long backlog can actually hurt your short-term margins. If you sign a fixed-price contract and suddenly labor and materials cost way more while you're still figuring out how to build a brand new complex jet or drone, your expected 12% profit margin can quickly plummet down to single digits. Let's look at why those materials are costing more in Section 4, Supply Chain Choke Points, the geopolitical reality. A single germanium ingot brilliantly illustrates the exact problem facing these production limits. Right now, tighter Chinese export controls on rare earth elements are seriously threatening European and U.S. defense supply chains. These elements are absolutely vital for permanent magnets, guidance systems, and sensors in advanced weapons. Honestly, you can't execute on a $200 billion backlog if you literally don't have the metal to build the microchips. It's that simple. To survive this intense material squeeze, defense companies are scrambling. Major European firms like Rolls-Royce, BAE Systems, and Rheinmetall are actively adopting tangible, real-world strategies to mitigate raw material supply disruptions. As defense spending scales up, these companies are desperately trying to figure out how to keep their assembly lines moving when global supply chains start to fracture. We can basically break their survival tactics down into three main layers of resilience. Number one is stockpiling raw materials. This remains the core short-term hedge against disruptions. Number two is supplier diversification, literally just finding new places to get the goods. And number three is recycling and material substitution, like developing brand new alloys that require fewer of those rare earth elements. It is a constant, ongoing battle to secure the supply line. Finally, let's wrap this up with Section 5, picking the winners, capital and discipline. As we bring all of this together, how do we spot the actual winners in this space? Where does the true profitability actually lie? Well, if we look at the margins, early ramp-up phases on new defense programs usually yield pretty thin margins, around 5 to 10%. Once a program matures, that climbs up to maybe 10 to 15%. But the real gold mine? It's the aerospace aftermarket. Supplying parts, maintenance, and upgrades for existing fleets generates massive 20 to 30% operating margins. The real money isn't always in building the shiny new jet, it's in servicing it for the next 40 years. Ultimately, the true winners here share a very specific set of characteristics. They use conservative cost assumptions on their contracts. They stagger their capacity investments rather than just blowing all their cash at once. They maintain serious balance sheet resilience, specifically keeping net debt below 2.0x EBITDA. And crucially, they avoid late-cycle, overpriced mergers and acquisitions. Operational discipline and smart capital allocation matter far, far more than simply winning a flashy, headline-grabbing contract. Which leaves us with this final, vital question to ponder. Are these global defense giants truly ready to execute on this $2.8 trillion boom? Or are they quietly sinking under the sheer weight of their own backlogs, strangled by supply chains and labor shortages? It's a lot to think about. The next time you see a massive defense contract in the news, make sure you look below the surface of the iceberg. Because execution is everything. Thank you so much for joining me on this explainer. Keep learning, stay curious, and I will see you next time.